Our next guest says the economy is showing enough resilience to keep interest rates where they are. You're not in the camp that they're going to go higher. David Bianco is here, DWS Group, America's CIO. We were just hearing from Roger Ferguson, who I think is in a wait-and-see mode. You seem a little more positive than that.
Well, when it comes to interest rates, we think the economy has been resilient enough that they can stay where they are. The Fed might do one more cut because the Fed wants to take insurance out against the risk of inflation reaccelerating. And why not take out some of that insurance when the unemployment rate's only 3.5%? So the economy is good enough, thanks to jobs and service consumption, to keep interest rates where they are. Let's keep an eye on long-term yields. They probably stay where they are, but there is risk they can even go higher given the deficits and so forth. But we've got a situation where the economy is good enough to keep interest rates high, hopefully not much higher, but earnings growth has been very, very stagnant. And this quarter, earnings growth are likely to be down 4% year on year.
So the good enough, though, does the good enough turn into soft landing, or does the good enough turn into recession?
So this conversation has been going on for a long time, and we still believe we're going to see a couple of quarters of small contraction in GDP, maybe not enough damage to the labor market to call it a recession. But the bigger point would be, we're in a soft patch, especially a soft patch for earnings growth that we think lasts well into early next year.
Why do you think the markets are in for a 10 to 15% correction if the economy is good enough, if rates, especially in the long end, even if they stay right where they are? Right. We have digested that, and here we are, we're 90% through earnings season. Well,
there's been a lot of celebration about there not being a recession. But I think what people will come to realize is that the growth is also not that great. There are spots where the growth should occur, tech, but then the question is, are these valuations reasonable enough? And many equity investors, I don't blame them. It's been a great market to be focused on and overweight on, but many investors have forgotten about the fixed income market. That's a market at the short and intermediate duration maturities. Even take a little bit of credit risk. You can get a 5-6% return. I don't think the S&P is going to be up that much from this point to a year from now.
So what would you recommend folks who are listening and watching and thinking, oh my goodness, well, what do I do about that?
Well, I'd take a look at fixed income. We are overweight fixed income. We do make asset class recommendations and have strategies at DWS across all the asset classes. Right. I do focus on equities and our active equity strategies. In that space, there are still some things that we like, selection within small caps. We like the healthcare sector.
But do you like the healthcare sector because you think it's a defensive sector, or do you like the healthcare sector because you think there's some great opportunity here?
The main reason for the attraction to the healthcare sector is that it's strong long-term growth at a very, very reasonable price. And I think, yes, they are going through a bit of a soft patch in terms of earnings right now, but this is not a bad place to be for some defensiveness as well. We like biotech, we like devices, we like medical supplies, even managed care. Big pharma, right. some have some great outlooks.
Are you of the view that all the folks who are holding the Magnificent Seven, I don't know if we call them Magnificent anymore.
Grade 8.
We're over that?
We're moving to Grade 8.
The Great, what did you say?
The Grade 8.
Now you're going to the Grade 8?
No, just big.
What are you adding on to what's the 8th?
Netflix, normal.
Oh, Netflix, okay. So are you imagining, though, a rotation out of those stocks that's either happening now or will happen and move into some of these stocks that you're talking about? Or do you think people hold on and that's new cash that goes into these places?
Well, so first, the 10 largest companies in the S&P, which are mostly those names, are almost a third of the S&P 500. So if you own the U.S. equity market, the S&P 500, you are very overweight those names just by the nature of the S&P having lurched toward being growth and tech and oriented. We think, one, it's worthwhile having diversification from that into other sectors and other even regional equity markets. We were overweight those names for many, many years in the tech sector and growth stocks. But this year we've been more cautious on that, trying to find other sectors and other asset classes. I think the market does get led downward by those stocks on that valuation concern, where people say these interest rates and that not being enough growth, these are great companies. It's the market that's put overly demanding expectations on these companies.
Right.
We've already seen double-digit % declines in the likes of Microsoft and Apple. NVIDIA is down 8% from its highs.
Yes.
And the overall market has been pretty resilient. So is it possible that we see just the change in leadership take over?
That is a good argument for seeing continued buoyancy in the market, resilience in the market, and avoiding perhaps a sharp correction. But you're asking a lot of the other sectors to overcome those big weighted companies, and the tech sector is the largest. The second largest sector is healthcare, which is why if the market can find resilience, even with tech softening up, I think we need to see it out of healthcare, probably financials too.